Hopefully this is working and the sound quality is good enough. This is an overview now of how to approach this dashboard. Really what should come first is understanding the strategy, and this is something that I've just built alongside it just to keep me out of trouble. The whole premise really is to find out whether or not the wind is behind me with any particular trade, and if anything is standing against that. So it's a confluence check, and this is taken from the legacy reports from the CFTC website, which is updated every single week, and it's a creation that's come about as a result of the journal and COT spreadsheet. Now, I've already explained roughly how this works in 3 videos previous to this. Very quickly, we start with the collection of 3 years worth of open interest and net long and short data. Now, this is a massive advantage and one of the strengths, if not the strength, of the whole COT spreadsheet and dashboard, which I'm about to show you. It's just amazing in terms of back testing results that you can do and find out how certain currencies have behaved at certain extreme levels. So absolutely, this is very important. I've just added a different report as well. That really didn't yield any greater advantages, but primarily we're using the legacy report. This one here was the traders in financial futures. So there's really 2 reports that the CFTC publish every single week. So yeah, so we already know this. As I said, I've explained it in previous videos. So we just look at the latest net COT data and the positioning, whether or not it's at a positive or a negative number, and how it's performed over not only the last 3 weeks here, but also where it stands within 2 other windows, a 6-month look back and a 3-year look back. Gives you a weekly change, the open interest percent, open interest share, etc. So this, again, it's all there. This then gets transferred further downstream into the currency scores section, which you can see here. At the moment, US dollar has a bullish build, Japanese yen has a bearish build, although we have just recently had a Japanese Bank of Japan intervention, which has seen a great deal of strength being put into the Japanese yen. Pair constructor, that then follows. It just adds the pair score, the score strength, the bias, participation, where money's flowing, gives you a trade rank, and then gives you a trade quality score, which then filters into the very last tab, which is the weekly FX signals tab, and that's the dashboard. So out of all those previous tabs, this is the culmination of all of that. And I appreciate that looking at this with as many colors on it. So if we take the Aussie dollar Japan, for example, you get a pair score, you get a gate 1 status jumping across quickly, you get a gate 2 status, you get a strong buy, which is only a directional bias, it's not a short-term path. I'm just going to keep going. It gives you a trade or a no trade signal. It gives you a conviction and a trade rank, which then filters into these later columns. It suggests that you put this on a watch list. However, there's a crowded flag here. And if we go down, you get an explanation of what crowded actually means. Again, just pause the video and take a look. Then it gives you a positioning read. It gives you a fuel check to let you know whether or not there's pressure behind the move. If there is, you get a room to run signal. If it's not, if it's crowded, that means people have been in that particular short trade for a very long time. So it's just a position that is overextended. And then we get a signal versus the fuel read. And again, you can go down here and you can read the context to that, no problem. And you then get a long leg extremity, but you don't get that on the US dollar pairs. You only get it on non-US dollar pairs. Same for the 6-month early warning, which looks at a 6-month window look back rather than a free week or a free year. And then finally, it spits out a trade grade and a short-term path signal logic, which again doesn't work on US dollars because US dollar doesn't have its own published data. So yeah, there's a lot. there's a lot of information that's gone into this, and it's simply this. It's not designed to tell you the direction and when to enter. It's not that signal service. It doesn't do that. The whole idea is it just checks off certain risk parameters. And again, I appreciate that this is very complex to have a look at, and you can easily get lost. You don't know what one to take notice of. I mean, I have put down instructions here of how to read the dashboard. Again, you can pause the video and take a look at this. But that was the reason why I created this, because I'm taking all of the best columns, all the ones that you need to pay attention to, and I'm attaching it here to the FX COT weekly dashboard. So for this, you get a link to the YouTube channel where I'm going to post some more videos on, most importantly, the strategy. And then once you get a handle on the strategy itself, you'll then be able to appreciate this, hopefully as a fundamental confluence checker, i.e. is the wind behind you in that particular trading decision, or is it against you? So I'm just going to go through this. I won't spend too much time on it. It's relatively straightforward. At least I hope it is. So it's divided into 4 categories. So you get grade A trades. These are the ones that would have the confluence, the wind behind that particular trade. Aussie dollar, US, and US dollar Swiss franc. These are written here in, I guess, card format. So this is one card that shows the Aussie dollar, US dollar pair. It gives it a grade A. And below that we get the US dollar Swiss franc as well. So these are the only 2 that have the cleanest signals behind it. Now, then you get down to the macro directional bias strong sell, and this is important. This is not a short-term signal. I can't be clearer about this. It's not a short-term signal. It may head in that direction, but based on the macro sentiment, and that could take weeks, if not, months, I suppose, to ultimately play out. This is really reading from weeks and weeks of data collection to see where the smart money, institutional money, is headed. So macro directional bias, not to be read as a short-term signal. And that, if we look back here at the spreadsheet, that's here. That's the directional bias. Okay. I'll just say this: directional bias is the overall long-term direction of that particular pair based on the fundamental data that's collected, but it's not the short-term path. Don't get those 2 mixed up. Okay, then you get down to trade status, which is the watch list. So this one is worth putting on the watch list. It doesn't mean you can trade this, but if there is a trading setup through that trading strategy that I'll post, then of course take it. It's on the watch list for a reason. It might be that there's no setup that particular week, and then we'll just see this refresh next week, because every single week it gets updated and refreshed as per the latest COT data. So the next release at the time of this recording is going to be the 8th of August. It says Saturday because usually I do this at the weekend, ready for the next trading week. So at the moment, as it stands, this is the latest information that's available. Okay, so then we get a 6-month early warning. It's letting us know that Aussie dollar in a 6-month window is reaching a 6-month low versus a 3-year range. I'll talk more about that at the bottom because there's a chart that explains it in a little bit better detail. The positioning read, Aussie dollar is neutral bearish build, and it says here, right here, bearish build -4. So it says build means shorts are still growing in a bearish direction, which means Aussie dollar is getting weaker, and the unwind, which is the opposite, shorts are being covered, so this will start to reverse. But at the moment, this is in a bearish build, shorts are still growing, US dollar in a bullish build, and then that's obviously longs are still growing because it's just the simple opposite, a bearish build and a bullish build, obviously. Okay, then we get the fuel check. So this one here says not crowded, no pent up unwind sitting there waiting to fire in either direction. So there is fuel behind the particular move, and that's coming from this one here, column M, and again you can take a look and read the different contexts behind each one. But ultimately green, room to run, is good. And then you get signal versus fuel. This one here also says aligned, positioning is mid-range, nothing building against you either way. So both the signal and the fuel check suggests that this should be a relatively clean trade to enter. And then lastly, on the card print, you get the upcoming news events that will likely affect the US dollar in this case, which is the NFP, the non-farm payrolls, which come out the first Friday of every month. And this is a countdown timer, and this is the date of that release. So a surprise here could revise this read because it is a high impact news event. So I tend not to trade around these particular times. Okay, and then it just moves on to the next category, which is US dollar Swiss franc. So that is grade A. These are the cleaner setups. Then you get into grade B, which has a soft flag, which means there may be 1 or 2 flags that currently stand against this. So for pound US dollar, for example, although this is a prime setup, we do get a couple of flags here. So crowded basically means that the pound shorts are still building, and then if you hover over this, you get an explanation. Extreme and getting more so, fuel is still being loaded and nothing has lit it. Can stay this way for weeks or months. And then we get a signal versus fuel conflict. This is actually a caution, hence the red. So nearly everybody is currently short in this particular. There is some room left, but not much. A rally against you is realistic. So it just means that you'd be entering into a trade that has been a long-term bearish direction, and it's looking like this trade could start to reverse. So it's something that you want to be very cautious of. So hence the grade B status. When that happens, you don't know. It's just something to be aware of. All right, so that's it. So grade Bs, we've got lots of different grade Bs. I'll just move down, and then we get to the grade Cs. So this is the one where we get more flags that are against this particular trade. This one here is a strong buy, for example. Now I'm going to go into US dollar Japan in just a moment, and I'm going to show you how useful this information here is. Now this printed at the beginning of last week, so I think it was maybe like the 25th of July, something like that. And the direction of US dollar Japan was still very much bullish. You can see the macro direction was a strong buy. Again, not a short-term read, but the overall thesis of the pair's direction. So even though it had an excellent trade rank, prime setup was there, we did get this warning signal. Everyone's short it. When they buy it back, it rallies straight into your trade. So signal versus fuel, opposed. And if we have a look at this, what this means is that, yes, you could still be in a strong buy, but at some point it's going to reverse against you. And if I look at US dollar Japan on the daily chart, if we just go back here, this has been in a very, very long-term bullish trend since it broke these highs here back in July 2025. And yeah, so it's just continued up and up and up until it got to a pretty decent psychological number. If you notice this, it reversed exactly at the 164.00, an even number. Not a surprise there. This was what we called an intervention by the Bank of Japan, because their currency has been just deteriorating for a very long time, and the Bank of Japan has just stepped in to try and save the yen from capitulation. And so what did I say? I said that this read here, this even last week was printed. So we were looking around about the last week or so of July. And then if we go back here, when did this actually turn? So the 28th of July. So that would have been published maybe about the 24th of July, giving us an early warning signal. And then what happened? It completely fell. No longer the strong buy because of the signal versus fuel. So these are ones that we need to take a careful look at, because like I said, it's not a timing of when you should get in to a trade. It's not a directional tool. It's simply, it lets you know what the data is looking at, and it's data, it's quantitative, it doesn't lie. If there's going to be some kind of divergence or pull the opposite way, then these flags start to appear. Okay. So yeah, so that's all the C trades, and then we just get to the no signals, which means these trades are not in my particular favor. It doesn't mean that setups won't occur here. Of course it could, but these are just filters that I just won't pay attention to for this particular week. This may change next week, of course, but it's just time saving. I won't bother looking at these ones. So at the bottom here, we've got a couple of handy charts. Position extremes. If you don't know what position extremes means, I would definitely either pause the video or go into AI and then just ask for a simple breakdown explanation, because I'm sure it's going to explain it a little bit easier than me. But in a very crudest sense, you would never know by looking at a price chart where this is sitting relative to 3 years worth of history. Hence the reason why I started this video by looking at this. This is a massive amount of data, and every single backtest that I've compiled suggests that when a currency sits at the floor of a 3-year percentile check, so what it's been doing over the last 3 years, it's found that the euro right now is at 1.2 percentile. So right at the very floor. And then what usually happens with this, it's reversal fuel. So we had last week the Japanese yen. Currently it's 5.7 this week, but last week I think it was less than that, around about 4, sitting at the 4th percentile level. And we've just seen that, well, reverse hard. So yeah, so these are handy. Then we get the currency strength ranking. So typically someone will take a look at the US dollar, saying that's a strong currency, and you'd pick that against a weak currency like the euro, for example. So you would be long US dollar, short euro. So euro US, you'll be looking for shorts, right? Because euro will be the base and the US dollar will be the quote So it would just work in reverse. This one here gives you the 3-year history. So this is pretty much what this is here, but it would make more sense if that was up one more level. And it just shows that what happens when currencies hit the absolute extreme floor. So the extreme floor is either 100 or 0, just like I explained here, 0 or 100. But this time we've just got it on different axes. So 100, what happens? So the New Zealand dollar, when it hit 100, so that happened, I think, just, what's that, like July 2024. As soon as it hit it, bang, you get a huge reversal. The same for red, Japanese yen. I think that was April 2025. What happened when it hit the 100 ceiling? Well, you can see it. It just completely dropped all the way down, and now we almost hit the opposite extreme level. So this is something that, again, I'm very, very interested in. The data is very positive about this. Once a currency has hit one of these extreme levels, it's a positive confluence as far as I'm concerned. And again, one more example here. You can see this. This is the CAD. What's that, like February, maybe 2026 of this year. Hit the 100 percentile level, and then it completely reversed the opposite way. So this is institutional buying. This is something that you can't see by looking at a chart. You have no idea where these levels are in terms of their extreme levels, and this is by far the most important part of the entire design. Okay, so then we get to net versus open interest. So this just gives you an idea of what the positioning is doing, where people are putting the money, how many people are coming into a crowded room, for example, and still joining the crowd, and how many people are now leaving that room, i.e. taking their trades with them or shorting it the opposite way. It just gives you that information here. You can just scroll over each one. Evidence, does the field flag actually work? And yes, it does. So trades that are aligned. So we want to go to the top, right? These ones here. So it's aligned, signal versus fuel. The trades that are cleaner by far have the better win rate. Here, 7.12R risk to reward. So definitely. And then as we get to caution, it drops a little bit, and those opposed, definitely the ones that are not working out so well. So we want to take advantage. And this is proven based on my own testing as well. So again, all of this is testable. It's not something that I've just simply made up. Trade journal, is the edge actually holding up? So at the moment I've got a 47.6% win rate. Dropped a little bit because I did take a couple of losing trades last week. Total net return is 8.18, and the average planned risk to reward is 1.2.39 risk to reward. Edge by fuel state entry. Room to run, if you remember, room to run was up. No, where was it? Yeah, up here. Yeah, this is it, room to run. And if you remember, we took it from this one here, column M, field check. So that was the legend or the context. And those ones that suggested the trades are entered with room to run. All of this has been journaled. There's a 100% win rate. Coiled at a 50% win rate. Squeeze 60, crowded 14.3. So as trades are added to this then ultimately will become the edge. But so far it's looking positive for grade A trades. This one here talks about the fuel state, running total, trade by trade. And then we get to the last two, which is win rate by trade grade, which is the whole point of this. It's suggesting that those trades that have either an A plus or an A grade rating have a much higher win rate, over 80% win rate for A plus. What do we have here? 61% win rate for grade A, grade B drops, C drops, and D drops again. So, yeah. And lastly, squeeze confirmed, the one fuel state with real timing value, crowded and coiled don't reliably time anything on their own. However, squeeze confirmed is the exception. When you get that squeeze confirmed flag, this is a genuine validated follow through rate. So again, this really comes down to this one here. Once we get confirmation that the squeeze is confirmed, then we can start to trade this in the reverse direction. So if anything, grade A's are the best. The more green flags we get, obviously better. And we want to pay attention to currencies, just like the Japanese yen, which last week just hit the, remember this is updated every week, the almost bottom of the floor here and started to reverse. New Zealand dollar is also in that direction as well. So hopefully this is useful, and just, yeah, I'll be publishing a couple more videos about this particular strategy. Again, strategy first, get your head around that, and then after the strategy is locked in, then you just simply come here, you have a look at your particular pair that week, and you see where does it sit relative to its grade level, and pay attention to where it's sitting in its percentile range as well. And the more positive flags we get, the data suggests that's where the wind truly lies. All right, that's it.